Hi, I'm Keith McCullough, and I wanted to introduce the Hedgeye Risk Range product. What is that, the Risk Range product? It's a tool that's designed to help you sell high and buy low. In other words, it's a quantitative risk management tool. Again, it's not a technical tool per se, the way that a lot of people have sold you technical tools. This is a proprietary quantitative risk management tool that is built on three really simple factors: price, volume, and volatility. Volatility is the one that a lot of people don't pay enough attention to. Of course, that is the brother or sister to the price. So again, we spent a lot of time on that three-factor model. Again, price, volume, volatility. And what we're really trying to do across 20 to 30 different risk ranges, and again, those ranges can be anything from the S&P 500 to the 10-year bond yield to something like Amazon or Apple. What it's designed to do is help you sell at the top end of the range and buy at the low end of the range, or cover your shorts at the low end of the range. Again, we don't discriminate. If you want to sell short at the top end of the range, you cover at the low end of the range. If you want to buy at the low end of the range, you sell at the top end of the range. So ideally, what you're doing is making much better decisions than chasing markets like many do, chasing charts higher after they move or freaking out and selling them lower after they fall. We don't want you to do that. Who's it for? Well, it's for anyone who wants to make better decisions. Who doesn't want to sell high and buy low? I know you all do. But of course, at the end of the day, this is for more active traders or people who are more actively risk managing the sizing and timing of their positions. But again, this is a really important tool to use whenever you're looking at the market each and every day and thinking about whether or not it is or is not a good time. So what is it? Ultimately, it's a long list of things that really matter. So the top 18 things will be things that you'll remember. So again, the S&P 500, the NASDAQ, the 10-year bond yield, gold, etc. Big stuff that matters, and it's also global. So we'll have things like the Nikkei in Japan, the DAX in Germany, for example. We'll also have currencies and commodities. The price of oil will be included in that list as well. Then we add the wild cards. So the wild cards are effectively the summary of what you're asking about. So again, we use our subscriber base to really tell us what really matters. A good example this year is that we've been using the FANG stocks because people really care on making good decisions within the range, within the Hedgeye risk range, on things like Amazon and Apple, to be specific. Then finally, there's the trends. So we call them trends, Hedgeye trends. That's the intermediate term trend. 3 months or more. Now again, that will be color coded. So for example, if something like Amazon is bullish, which it has been this year, it will be green. So the trend is bullish, and then the risk range is wrapped around that. That's somewhat like your batter's box, where you'd be looking at pitches to hit because you're selling high, and where you'd be looking at pitches to hit because you want to, again, buy lower. So again, you have your risk range and you have your trend signal. The trends are color coded, just to keep it super simple. So how about a couple examples of how to use this? First, the S&P 500. Really simple. Where is the risk range of the S&P 500? Let's say that the low end of the range is 2,600 and the high end of the range is 2,650. So again, when it gets to 2,650, you sell, and when it gets to 2,600, you buy, or if you shorted it at 2,650, you cover at 2,600. Within the middle of the range, I do a lot of nothing. That's where you should have a lot of patience. So again, you sell at the top end of the range and you buy at the low end of the range. If you're using something like the 10-year bond yield, what you're doing there is you're using it as an aid to help you trade bonds or bond proxies. So the 10-year bond yield, let's say that the risk range is 2.25% to 2.50%. So at the top end of the bond yield range, 2.50%, you're probably going to get an oversold signal in something like the TLT, which is a good proxy for long-term bonds, and vice versa. This is a tool that I have to use. I have to use it every single day. I built this tool. I used a lot of trial and error. I've been doing this for almost 20 years. I got tired of the old walls tools, these technical tools that are really one factor based. They're price momentum in nature. People are chasing price all the time, using their emotions, chasing high, freaking out low. I don't want to do that. I need this tool, and again, it's a price volume volatility tool that I built myself. I literally cannot do my job without this tool, so I made this available for other people to use at a bare minimum for you to use as an insurance policy to check your emotions, or at a maximum, like me, to just constantly make good decisions within the @Hedgeye risk range.